All right, so let's move on to the next part of the financial statements, which is the balance sheet. So the balance sheet tells us how financially strong the company is. How much does it own? How much does it owe? Because some companies can make a lot of money. They show great profits, but they are not financially strong. So the moment they get hit by a recession, by a financial crisis, they could go belly up and go bust because they took on too much debt in order to get their business running, or they took on too much debt in order to generate the profits that they have. So when we look at a balance sheet, there are basically three items in a balance sheet. We have got assets, liabilities, and the shareholders' equity. So assets are basically what the company owns. Liabilities are what the company owes. So what you own minus what you owe is what's left behind for the shareholders. And that's known as shareholders' equity. Now, under assets, you've got current assets and long-term assets. So current assets are assets that a company owns that it can convert to cash easily within the next 3 months. So for example, short-term investments, cash in a bank, inventory, it can sell its goods to collect cash easily, accounts receivables, which are things that basically the company has sold its product and awaiting payment from the customer. Long-term assets are things that the company owns that it can't sell easily. So for example, machinery, equipment, land. So all this takes a couple of months, more than 3 months, to liquidate in order to create cash. Or even goodwill, the brand, all these are assets, but they are long-term or even intangible assets that you can't really feel, but it takes someone to buy the asset to liquidate it, right? Now, liabilities, again, you've got current liabilities, which are things the company owes, it has to pay within the next 3 months. So things like accounts payable. So it owes money to creditors, it has to pay that money fast. Short-term debt, taxes payable, right? And then the company's got long-term debt, which are long-term loans the company takes from the banks that it can pay back over many, many years. All right, so let's take a look at a balance sheet, what it looks like. And again, let's recognize the assets, the liabilities, and the shareholders' equity. So to do that, again, you can go to any financial website. You can download the financial reports of the companies. But again, I prefer to go to Morningstar. All right, so off to Morningstar again. And let's look at the same companies we looked at previously. Let's look at Apple, for example. All right, so I'm at Apple right now, and once again, I'm going to go to financials. Go on to financial data. All right, so previously we looked at the income statement. We're now going to go to the balance sheet. Now, bear in mind that for the income statement, we are always looking at annual, right, or the last 12 months to see how much money that a company make over a period of time, which is again 12 months or the last financial year. But for the balance sheet, we're looking at a particular point in time. So at a particular point in time, how much does the company own? How much does it owe? How much does it have? So what point of time do we want to look at would be the latest quarterly report. So in other words, when I look at a balance sheet, I always look at the quarterly report, the last quarter, because that's the most recent. If I look at the last annual report, it could have been many, many months ago because the company's financial year could have been 6 to 9 months ago. So I always look at a quarterly report when it comes to the balance sheet. And I always want to look at the most recent quarter. So in this case, the most recent quarter would be the quarter ended June 2018. So I'm interested in this column over here. All right, great. So let's take a look. First, we have got the assets. So the assets are all here. Let me just highlight that. And again, we are interested really in the last quarter. Okay, so what are the total assets of the company? Total assets would be $349 billion, right? Those are total assets. And again, they are divided into the current assets okay, and the non-current assets. So again, non-current assets would be long-term assets. Okay, so these are the current assets over here. As mentioned, you've got things like cash in a bank, which includes cash and cash equivalents in a bank, short-term investments, accounts receivables. Now, bear in mind, this is important. We're going to go back to this later on. We call these accounts receivable. So basically, this is what the customer owes the company. Now, this is especially true for B2B businesses. So as a business, when you sell to another business as a customer, they will not pay you immediately. It's not cash up front. So if the customer pays cash up front, receivables will be zero. There's nothing to receive, right? But if the customer says, I'm going to pay you in 30 days, in 60 days, in 90 days, there are accounts receivables. And this is something which is pretty important because you want to ensure that the company's receivables are not increasing too fast, right? They should be consistent or declining, because if the receivables are increasing too fast, that means more and more people are owing the company money, which means the company can't collect what is due to them. It could be because some of the customers could be in financial difficulty, could be bad debt, and that never bodes well for the company. So this is something we'll go back to in the future. Just hang on to it and just understand that this is under current assets. You've got inventory and other current assets. So all these are your current assets. Your long-term assets, again, like mentioned, will be property, plant and equipment, accumulated depreciation, goodwill, intangible assets, and other long-term assets. Okay, so those are all your assets. Next would be your liabilities. So these are all your liabilities over here. Again, total liabilities for Apple, you can see it's $234 billion in liabilities. Total assets, we've mentioned that before, $349 billion in assets, right? So in other words, Apple owns $349 billion in assets. It owes $234 billion in liabilities. So if you take what you own minus what you owe, what do you get? You get your shareholders' equity over here, which is $114 billion. So this is what is left at the end of the day when all creditors are paid. Again, under liabilities, you've got your current liabilities, which are your short-term debt. Okay, accounts payable, which means you owe suppliers money, you have not paid them yet. Accrued liabilities, deferred revenues. And you've got your long-term liabilities, which include long-term debt, long-term bank loans, deferred tax liabilities, which you can pay back over 3 months or more, other long-term liabilities. All right. So basically, this is how a balance sheet is constructed. So what do we look for? How do we know if a company is financially strong? Okay. So there are a few things we look at. Let's go back to the slides right now. All right, so now we've taken a look at what the balance sheet looks like. Let's take a look at how we can analyze it. So we look at a few ratios, and the first ratio we look at is what is known as the current ratio. So the current ratio is derived by taking the current assets and dividing it by the current liabilities. So which one do you want to have more of, assets or liabilities? Well, obviously you want to have more assets. So you want the top to be bigger than the bottom. So a current ratio of greater than 1 tells you that the company has more assets than more liabilities in the short term. So that is a safe company, right? Tells you the company is pretty conservative. The next thing we look at would be the debt to equity ratio. So over here, we compare the company's total liability to the total equity. So if they take the total liabilities, divide by total equity, you get a debt to equity ratio. So this tells you how the company is financing its operations. Is it financing it through debt, which means borrowing money from the bank and from bondholders, or is it financing it from equity, which means to say selling shares? Now, obviously, the ideal situation is if the company has a lot more equity than debt. That is, of course, the safest. In other words, if there's more equity than liabilities, the debt to equity ratio will be less than 1. And less than 1 means really conservative. But in reality, very few companies have got a debt to equity ratio of less than 1. My company has, but not many do. In fact, many of the multinational companies, listed companies, have got debt to equity ratio more than 1, which means they've got more liabilities than equity. Now, that isn't necessarily a bad thing. Sometimes it could be good because it means the company is, borrowing money to expand its business and not having to make use of the shareholders' money. So that's good and bad to it. But if your debt to equity ratio is too high, it can become dangerous. So, what's too high? What's too low? So oftentimes what we do is we compare a company's debt to equity ratio with the rest of the industry, with its competitors. So for example, if you're looking at McDonald's, you could compare McDonald's to Texas Fried Chicken or Yum Brands or Domino's Pizza, similar competitors, and you want to ensure that the company you invest in has a debt to equity ratio which is consistent with the industry or lower, but not too much higher, right? So that's the way you can read if it's a bit too high, compare with its competitors. The next thing you can do is to look at the company's debt to equity ratio over the years. You could compare it over the last 5 years and to ensure that it's been consistent. If it's been falling, that's of course better, but if it's like increasing, that's a red flag. That's something to be cautious about. Okay. The final thing is you can look at the company's debt servicing ratio, and you want it to be less than 30%. So what does it mean? The debt to servicing ratio is equals to the net interest expense of the company divided by the cash flow from operations of the company. So what does net interest expense mean? Well, when a company borrows money, it has to pay interest to the bank or interest to the bondholders, right? So the total interest they pay out is known as the net interest expense. It's kind of like you and me. If we take on a car loan, a bank loan, we have to pay interest every year. So that is our net interest expense. So how much interest do we pay that's considered too high? Well, it's relative to our salary, right? So for example, in a year, if I'm earning $100,000 salary, I'm collecting salary in a year, 100,000, and I'm spending 30,000 paying interest, then what's my debt servicing ratio? It'd be 30%, right? Because 30,000 divided by my cash flow from operations is 30%. So that's a bit high. So the same thing goes for a business. You want to calculate the amount of interest the company is paying comparing to the company's cash flow from operations. Now, where do we find this figure? We get this from the income statement, which we looked at earlier on, under expenses. Okay, so under operating expenses, you can find a row that says net interest expense, right? Now, when you get the cash flow from operations, this is under the statement of cash flows that we'll be covering in a short while. So I'll show it to you in a while, right? So again, you want it to be less than 30%. More than 30% means the company is spending too much of its cash to pay for interest, right? Do bear in mind that certain companies, by nature of their industry, they are highly leveraged. And what highly leveraged means is that they borrow a lot of money, right, compared to the actual shareholders' equity that they have in the company. And it's normal for these industries. And that's what makes them more risky. So banks, for example, financial companies like insurance companies, property developers, and commodity companies tend to be highly leveraged. So do not have too many of those in your portfolio, because during a financial crisis, during a recession, these companies could drop by 80 or 90% because they've got so much debt, they have the chance of going bankrupt, compared to another company that's more conservative, that's got a lot less debt, right? So let's take a look back at the balance sheet and let's do our calculation for a few companies to take a look. So let's go back to Morningstar and let's take a look at Apple again. And let's see if Apple is a conservative business in terms of its debt structure. its balance sheet, right? Is it a financially strong company? So again, let's go to financials over here. Let's go on to all financial data. Okay, so as mentioned, we go to balance sheet and we want to look at the most quarterly, the latest quarter basically, right? So first thing, let's calculate the current ratio of Apple. So that's current assets divided by current liabilities. So total current assets are here and total current liabilities are over here. There we go. So you take 115,761 and divide that by 88,548. What do you get? Let me just pull out my calculator. 115,761 divided by 88,548. So that's 1.3. Okay. So the current ratio of Apple is 1.3. It's more than 1. It is safe. Okay. Next, let's take a look at the debt to equity ratio. So take the total liabilities and divide it by the total equity. Right, so for that one, let's scroll down. Where the total liabilities, there we are. Total liabilities would be 234,248. And the total shareholders' equity of Apple is 114,949. Okay, so you take the total liabilities, 248 divided by 114,949, that's 2.03. Okay, so Apple's current ratio is 1.3, its debt to equity ratio is 2.03. Okay, so like most companies, it's got 2 times more debt than equity, and like I said, it's pretty common nowadays. It's not necessarily a bad thing. So is it too high? All right, so what you can do is, again, you can take a look at related companies, other technology companies. For example, you can take a look at Amazon, Facebook, Netflix. These are all the technology companies, and compare them to Apple, and you will see that Apple's debt to equity ratio is one of the lowest among all the tech companies. All right, so like I said, you want it to be equal or lower than the other competitors. You could also look at Apple's debt to equity ratio a year on year for the last 5 years, and to ensure that it has been pretty consistent and not suddenly going up. Okay, great. Next, let's take a look at the debt servicing ratio. So for that, we have to take the net interest expense divided by cash flow from operations. So where do we find that? So for that, we have to go to the income statement. Excuse me. And once at the income statement, go back to annual. And under operating expenses, you would see, there we are, interest expenses. So if you take the last year, that will be 2323. Let me write that out. $2323 million. So that's the amount of interest that Apple is paying a year on its debt. Is that too high? Let's compare that to the cash flow from operations. How much cash is the company generating from its business in a year? So for that, you have to go on to the cash flow statement, which we have not covered formally. We will in the next part of the lesson. And we are looking for this figure over here. All right, that's right. Net cash provided by operations. I know it got cut off, right? So you take the last 12 months, 63,598. 63,598 million. Okay, so if you take 2,323 divided by 63,598, you get 3.6%. There you go. So the debt to servicing ratio is only 3.6%. It is very low compared to the maximum of 30%. So I would say that, yeah, Apple's a pretty conservative business, is financially strong. Why don't we look at another company just to kind of like compare? Let's take a look at, say, how about 3M? 3M is again in the Dow Jones, one of the biggest companies in the world. Those post-it notes, WD-40, your household appliances, a lot from 3M, right? Okay, so going to 3M, again, let's click on financials. Let's go to all financial data. Let's go on to balance sheet. And again, let's look at the last quarter. Okay, so what's the current ratio of 3M? Let's take a look. So take the total current assets over there, 13,890, divide that by total current liabilities, which would be somewhere down here. Oops, I drew that a bit too early. Okay, so 13,890 divided by 8,902. That's right. Current assets divided by current liabilities. So the current ratio of 3M would be 13,890 divided by 8,902. Answer 1.56. So again, that's above 1. So that means that this company has more current assets than current liabilities. It's able to pay its short-term debt easily with its assets. Okay, so that's pretty safe. Next, debt to equity ratio. So for that one, we take the total liabilities which is 10,365, and divide that by total liabilities. Or rather, sorry, take total liabilities, divide by total equity. Right, so 26,413, divide that by 10,365. So the answer is debt to equity ratio for 3M would be about 2.54. So again, it's got 2.5 times more debt than equity, right? And again, you can compare that year on year, ensure that it's not been rising or it's been consistent. That's pretty okay. And compare it to the rest of the industry in its competitor space. So if you like to compare it year on year, just simply go to the annual figure and you can kind of like compare year on year the debt to equity ratio. All right. Finally, again, debt to servicing ratio. We take the net interest expense, which is under income statement. There we are, interest expense, that's only 322 million on interest expenses, and divide that by the cash flow from operations. So again, for that, go to cash flow, and that's over here. Net cash flow from operations, 6,240. So you can see that it is very, very conservative. 322 divided by 6,240. It's just 5%, right? Much less than 30%. So again, 3M is a financially strong company. So this is how you can dissect the balance sheet and to tell if it's a financially strong company.